Hi, good afternoon, friends. On behalf of Axis Mutual Fund, this is Raghav Iyengar. I'd like to heartily welcome you to this brief introduction to our latest offering. I know we are right in the middle of NFO season. As I'm speaking to you, there are possibly four NFOs already in the market, and another four actually already are supposed to be launched anytime in the next 1 week to 10 days. So yes, this is a bit of a crowded calendar. At Access, our basic premise, and I think the fundamental reason why we exist is to provide value to our customers and our partners. We obviously like AUM like any other fund house, but we are not asset gathering machines. Everything that we have done in the last 11 years of our existence has only been uh, directed towards the customer interest. In fact, we were India's first ESG fund to have 30% allocation to foreign equities. This is another curated or rather a very special offering from us. It is, in fact, it is also appropriately named special situations, but it's also very, very special for us because this is an idea which is a little ahead of its time. And that is the reason why we have some allocation to international assets also in this portfolio, like our growth opportunities and ESG. This is going to be this is a futuristic fund. At Access, our primary job is to ensure that we are able to capture uh, trends which are able to generate good returns for your investors early in advance, get you invested, get your clients invested, and overall provide value to your portfolio. So these are the two things that I just wanted to talk about. We have a very, very star-studded panel with us to talk to you. After me, I would ask Chandresh, who's our MD and CEO, to join the conversation. After that, we have Jinesh, who's our head of equities. As you know, we have Ashish Nayak, who has been is a senior portfolio manager who would be actually managing the portfolio of special situations. Ashish is an old industry veteran. In fact, he's one of our founding fund managers. Joined Chandresh and Jinesh right from the time Axis Mutual Fund started off in 2010. And of course, lastly, to take some questions and obviously also to provide a more of a discussion platform is our own Ashwin Patni, head of products and alternatives. So all these people you have interacted with. So again, on behalf of Axis, thank you very much for taking the time to join us. Over to you, Tim.
Hello everyone, this is Chandresh. Very happy to be here, and thanks to everyone for joining us today. It's indeed a very important moment for us when we are launching a thematic fund called the Axis Special Situations Fund. Briefly, just let you know why we believe, and I certainly believe that this is a product idea whose time has come. Raghav did mention that this is a little ahead of time, but these days when change is so rapid, there is whatever as we've seen in the pandemic during Corona, some of those things which we thought will take some years for those trends to fructify and get well established, they've kind of taken root very quickly. And the future comes at us much faster than what we really anticipate. And basically for us, special situations is about finding those discontinuities, finding those disruptive forces, which at one level aid a number of innovative, creative companies which are willing to change. And change is not easy, by the way, but companies which kind of embrace change and bring about change in the way business is done and think very differently. I think it's a great opportunity for them. It also is not a great thing for people who are not able to change. So you have to obviously always, as equity investors, be alive to the fact that change is coming. And if there are companies not able to handle change, then more often than not, you have to stay away from that because they will not be able to create wealth. Looking at disruption, I'm just reminded of one simple anecdote. In fact, actually, it's a set of two anecdotes. 2016-17, I led a small study group from Axis to the UK. and where we had the privilege of listening to one of the technology editors of The Economist. A technology editor is basically people who talk about new emerging technologies and futuristic kind of stuff and how things will change over a period of time, and things like 3D printing and artificial organs and a number of things were talked about in that meeting. And then at the end of that presentation, a question was asked, so how much time do you think, and this is somebody obviously who is the technology editor. He is really very well known because he's representing The Economist. He is basically said, yes, I do believe that over the next 18 to 24 months, some of these technologies will get commercialized, which means companies will actually bring the product out to the market, and no, that will make very different kind of an impact to for people. So things like, how do you 3D print an artificial ear? Somebody who's lost his hearing, can you replace or insert something in the ear which is same, which fits in, and it's 3D printed? So those kind of technologies. And there were a number of things, walls which emit light, and so you may not need separate lighting. The walls will be painted and with control of electricity and all that. So I think lots of futuristic stuff. Now that was interesting, but I think the more interesting thing happened a year later. And a year later again, I had another study group, and we went to Oxford this time. And it so happened that we had the same gentleman presenting in that event, talking to us about disruptive change, etc. And what was very surprising is the stuff he had talked about a year earlier and said that it will take 18, 24 months to get commercialized. Many of those things were already there. So already out there in the market. And so there is this massive engine of innovation, of creativity, lots of big, small, different kinds of companies, research labs. They are all getting in, and they all want to make that big change. Because why do they want to do it? One, obviously, there's interest, but also very importantly, there's a lot of money in this. So there's this whole force of a lot of money being put up front to drive innovation, to set up new business models. And we've seen that already happen in many of the products and services we are using. I mean, one of the big examples, I do not know how many of you watched the SpaceX launch, when we put 4 cosmonauts, 4 astronauts onto the International Space Station. And you just go back and see how it is so different from how things were done 50 years ago when the first time man went into space, or maybe 60 years ago. So innovation and the force to drive change is really out there. I think the pace is only accelerating, driven by technology, driven by money. There is just so much amount of money available to support and drive these disruptive change, because at the end of the day, you want to be first to market and you want to capture large parts of the customer base. And that is the second reason why we as fund managers and you as advisors cannot stay away from this whole change which we are seeing. Because we are entering into a world where it's a winner take all. I mean, if Tesla and SpaceX is really successful, I do not know what it does to their other competitors. Some of them are very well established companies like the Boeings and Lockheeds of the world. And in fact, for many of NASA's own programs, I think they may not just need to run them. And SpaceX, Elon Musk's company, can just wipe them out. So I think it is a phase, and it is happening industry after industry. So you have to be alive to this fact that world going forward will be a winner take all. The winner will be characterized by somebody who is either ushering in disruptive change, ushering in new technology, or is somebody who's a user and drives changed behaviors, changed business models for the customer, ultimately adding to value. And that old thinking that, hey, if you are number one in your field, your market share is there, you are safe. That's not true. And it works the other way as well. If you can be a great innovator, there is no limit to the kind of market share you can have. I mean, people can go out and look at 50, 60, 70% dominant market share, as we've already seen. And in fact, it's creating some problems on the other end, where people are saying maybe too much power is coming and too much wealth is getting created by a few number of companies. But as investors, for our investors, for you as advisors to advise your investors, I think this is an area which we cannot neglect. More and more wealth will be generated by the disruptors, and that's what exactly Axis Special Situation Fund intends to do: identify these forces and the companies which are driving that, and hence are going to generate a lot of wealth. I will stop here. I will ask Jinesh. I'm sure all of you do know Jinesh. Jinesh heads our equity investing piece of the organization. Under him, the organization has really made phenomenal progress. The entire quality theme and the way it is executed last 4 years, Jinesh has been driving it. And I'll hand it over to Jinesh to take us forward on the thought behind this product, what we really intend to do, and how we really want to run it. Over to you, Jinesh.
Yeah, hi. Thanks, Chandresh, and good evening, friends. Thanks for taking out time. Just taking from what Chandresh said about the innovation, just adding few points and then coming to the fund. If you really see last 10 years, 12 years, the innovation has gone through the roof across all sectors. And thanks to lower cost of capital, there is huge money which is being backed by best brains, and the combination of best brains and low cost of capital is leading to massive innovations, and this is all across the world, and India is also facing that. What happens in this is the business cycles are shortening. In the initial years of my career, when we used to see the company, we always used to see that 10-15 years nothing will happen to this company, it will be a steady 15-20% growth story. But now that is not the case. With the advent of technology, innovation, and the adoption of that technology, I think there is a massive shift happening in the business environment itself. And the promoters or the professionals who are not ready to accept this change are seeing significant derating in their business model itself. And you have seen this all happening across all sectors. Let's take the case of media as a sector. The newsprint industry was darling of the market 15 years back, and now you don't see those companies into top 10, 20 names in terms of market cap. And this is slowly, steadily uh, coming into all the sectors where management or a professional is not ready to change its business model or not ready to change the game. Then he's getting wiped out, and that market cap derating story starts for that company, and someone else, be it an unlisted space or be it a listed space, takes away the entire profit pools. What we have seen in last 10 years is the profit pools are getting concentrated to top 4-5 names in the sector. Winner takes it all kind of a market. The top 3-4 companies have large market share in their sector, and rest is all tail. And frankly, there are various ways to play this theme. We should, as you would really see, there are set of people who are innovating, who are totally disrupting and destroying the existing business models. There are other people who are adapting to that, and who are changing their game, maybe slow, but they are coming back. A classic example here I would give is the Microsoft, how they have changed the game from sort of a software company to a cloud company now. And the third portion is the enablers. classic B2B, B2C stories like TCS or Infosys of the world, who have been at the forefront in terms of enabling this disruptions with the innovator. So there is a massive shifts which are taking place. Fortunately, as an investor, we have those themes to play all across the world as well as in India, and that is the best part of the financial investor, that we go by the trends, we go by the business models, and whatever we like, we invest, and whatever we don't like, we just chuck it out from the portfolio. But our aim is to make disproportionate returns for the investor, and that is how the themes are being played, and that is how we would like to play Axis Special Situation Fund, where we are very, very convinced that the disruption is all around us. It has been accelerated, you may call it fortunately or unfortunately, by this pandemic. And this is forcing the companies to innovate to stay relevant. And this is creating also a good investable opportunities for us. Uh, Also, if you would appreciate that markets are inefficient in factoring this disruptive change, and that is where if as a team, if we have a sort of a foresight on advantage or over other, then definitely we can also find some big themes which can be good wealth creators for the market. Hari, can you load the presentation if possible? Hello? Yeah. Can you go to slide 3? Yeah. So, yeah. So, yeah, this one. So if you see this slide, you will really see how changes are happening the long-term front, medium-term front, and even at the short-term front. How do we play this in our portfolio while taking into account the diversification and the other risk parameters? Is by creating a tight portfolio of disruption, who are pure disruptors, who will disrupt the existing business model and create wealth for us in the long term. Then there are medium term opportunities in the special situation, where there are significant shifts in the sector dynamics itself. Again, the case of COVID and the adoption of technology, and suddenly some of the businesses are looking much better than the others. And the third way to look at this special situation fund, is the event based. Again, the COVID is an event, GST is an event, demonetization was an event, LNFS crisis was an event. So some opportunity, if we can cut across on the event-based story. So these are the three ways we would like to position our portfolio while taking into account the risk associated with the overall disruption or the special situation theme. Can you go to next slide? So as I was saying, disruption is all around us and accelerating. Disruption leads to innovation. Innovation creates again disruption, and the disruptive growth is an opportunity for the investor to capture significant value creation over a period of time. Next slide, please. Markets are inefficient, as I was saying. It creates a potential for mispricing of the stock in the initial phases of the disruption, and that is where, if we can choose some of these great stories in different sectors, there is huge scope for a re-rating of those candidates, maybe not in short term, but over a longer period of time, and this can lead to a gap between the market expectation as well as the actual growth potentials, and that is where the wealth creation opportunity will come. Next slide. So if you really see, along with the world, India is also going through a phase of disruption and innovation. There is a lot of money sloshing around in Indian market. You would have seen the FDI flows, which has been at the record levels over last 2-3 years. and most of the private equity money is going into some of the great unlisted candidates who are now prime for IPOs, and that is where the disruptions are happening. Even for that matter, in the listed space, you are seeing a lot of companies now changing their game and trying to disrupt their own business model for future sustenance of their growth. So I think I would say this, it's an opportune time, and I think COVID has just created a bigger opportunity for disruption to get adopted into Indian businesses, and that is where we feel that India is at the cusp of a massive change in the overall behavior of the business model, and we are seeing some of the classic themes like edtech, education, online grocery, all those themes really becoming bigger and bigger day by day. So I think even in our industry, if you really see, we are seeing disruption, and if we don't change our game, someone else will come and disrupt the business. So all in all, I would say we are very bullish on this disruption theme. And as I said, disruption can be in the form of disruptive companies, adapters to that disruption, and also enablers to those disruption. Uh, and this is happening at a thick pace. And obviously, in next 2 3 years, you will see many companies coming out of this innovation or the disruption game in the form of IPOs, and who knows, they might become larger than the some of the existing Nifty names as well. So with this, I would just hand it over to Ashish to take you through the further part of the presentation on this special situation fund. Thank you, guys. Ashish?
Thank you, Jinesh. As Chandresh, Raghav, and Jinesh introduced this topic of disruption and the kind of special situations that we are looking at, just a few examples going forward. If you go to the next slide, in terms of as Jinesh mentioned, in addition to fintech, which is largely the digital payments and UPI, where a lot of government support has helped. Making payments easier, making payments convenient over a period of time. What we are now seeing is there are a slew of other industries, and we have mentioned about 9 big segments here, where what COVID has done is, they have kind of catapulted these industries to the next level in terms of adoption, in terms of penetration levels. What we are seeing is companies in the space, for example, in the online food delivery, or let's say from to going to e-commerce, or let's say grocery, or let's say just streaming services like OTT, to online gaming. All of them are gaining scale, and they are gaining acceptance beyond the tier 1 cities or the metros like Mumbai, Delhi, or Bangalore, and they are being adopted even in the tier 2, tier 3 states, cities, and across even some cases towns. And the reason why that's happening is because technology is becoming accessible, technology is becoming highly cost efficient, and that's actually accelerating this change much faster. So this is an estimate here of these few industries that we have put here, which Bernstein expects that in the next 10 years, some of them can grow up to 10x. That's the kind of disruptive growth that we are talking about across these various industries. And even if we say about 2 3 major players here, there can easily be about 20 to 30 new companies that can probably look at listing either in India or abroad, from these various industries where newer disruptors are getting funded and growing over a much faster pace with the COVID coming in. If we go to the next slide, in terms of how to look at disruptive growth, and that's really where we have leveraged Schroders as our partner, and how they have sort of run their global disruption strategy, where they say that disruption is not just about the disruptor. Obviously, that the innovator, the big disruptor, the Teslas or the Amazons of the world are sitting at top of like a tip of the iceberg, which is visible to everybody. They are probably the mega caps or the most visible companies with the highest sort of valuation ratios. Obviously, they are interesting names if we are able to invest in them in the right time. But what is also important is look, below the iceberg. look at the enablers and the adapters or of this disruption. What we mean as an enabler is a company which is actually letting the change happen in terms of enabling it. So for example, if there is a Tesla car which is an electric vehicle, there is obviously a battery which is needed, and the electric battery or the chemistry for that is a very specialized science which only few companies in the world have innovated on. So for example, a Samsung SDI becomes an enabler for a Tesla, or for that matter, even electronics or a semiconductor company like a Texas Instrument becomes an enabler for a Tesla electric vehicle. On the other hand, there are other companies in the existing industry who are able to adapt to these changes better versus the competition, and hence the disruption does not hurt them. So, for example, if we look at the electrical vehicle industry itself, we can see that Volvo as a company is shifting away from gasoline and diesel vehicles and moving to all electric or pure hybrid vehicles in the next 5 years. That's the kind of adaptation that we are talking about to change or disruption that kind of can benefit a player. Uh, Similar example here on the global front, if we look at the streaming services industry, and we have experienced it upfront, most of us have seen how OTT platforms like Netflix have gained market share over television and cable TV. So that is a disruptor here. And who is an enabler here is the telecom industry, who is actually giving access to this broadband data and to this data that is available for various people, and they are enabling this disruption. An adapter to this in the global context and even in India is a Walt Disney, who even in India has a Disney Hotstar, and with their streaming services across the world, they have been able to adapt to this disruption much better. What is also important is to in this disruption chain is to avoid the deniers, the incumbents or the players who deny the change, who do not accept that there is something going to change, and hence are not able to change their business model for various reasons. So, for example, the cable industry, clearly any company who is providing cable like will be a denier in this case. If we move to the next slide, here are a few examples in the Indian context. Now, while we have spoken about global giants and global innovators, some of the examples on the Indian scenario, the most common being the petrochemical giant in India, who about 5 years back announced in their AGM that they are going to move or diversify out of petrochemical business and move into other newer industries like telecom and retail. At that point of time, they kept on investing into various industries, starting with telecom, gained a substantial market share and disrupted that industry. And over a period of time, have been generating a higher market share and disrupting other industries like retail. And also partnered with global giants like Facebook to sort of work with WhatsApp and disrupt probably the digital payment space, or maybe even work with the Google and build let's say a 5G enabled cost-effective solution in some terms of a high handsets for Indian population. So that clearly shows that innovation is something that is not only happening globally. There are Indian players who have done this. But what is also important here is to understand when market actually appreciates this. It's only when if you look at the movement of this particular stock, that when these disruptions actually resulted in profitable growth, or when it resulted in substantial change in the profit and loss of the company, is when the market actually started giving more and more credence to this. If we move to the next slide. um, Also, what is also important is as you said, from a disruption perspective, it's not just the tip of the iceberg but the below the surface. So for example, one of the biggest enablers of all the disruptions that are happening globally is the IT industry. And the Indian IT industry, while traditionally has been into the outsourcing space, where it has been a leader globally, the players like TCS and Infosys a few years back realized that there is a change. Global IT industry is probably going to move towards cloud, and hence there are obviously going to be a lot of opportunities there, both from digital transformation and cloud transformation perspective. And hence they invested into it 5 years back, and we have seen the kind of moment in the sales or the order book of these companies that have generated, which are highly profitable when they have worked with global clientele on the digital transformation. And this also is something that was appreciated by the market, especially when they saw something like COVID happened, where more and more businesses had to sort of shut the offices and let people work from remote locations. And that's where cloud and other such transformations, which were happening earlier, kind of came to the forefront, and more business is now being generated by Indian IT companies. Just to mention here from an enabling perspective, there are other examples across the world. If you look at various other industries, so for example, if you look at the capital goods industry, automation is something like an enabler where many more companies now, many more factories are moving towards automation in terms of robotics, or also looking at smart buildings, smart infrastructure, where more and more technology is needed in terms of sensors, etc., so that less and less people can run it. So in a scenario like COVID, where there were social distancing, which was the norm, or there were very few people in the factory available to run the plant, something like this would have really helped. And again, that shows that the next round of private capex that happens even in India is going to have more and more automation. And there are many companies who are already present in this, both from the global giants as well as the Indian companies who are innovating on this. Similarly, if you talk about the telecom industry, it could be an enabler, as we said. So across the various industries, as we start looking at, deeper and deeper, we will find more and more enablers of these disruptions. If we move to the next slide, one of the biggest examples of adapters in the Indian context has been the financials industry. Starting from the private banks who have innovated, who have adapted well to the changes that have happened with the digital space, where fintechs have tried to take more and more market share in terms of their own digital capabilities, in terms of giving loans in 10 seconds, in terms of 3-click account creation, etc. They have been at the forefront, or at least been competitive versus the fintechs. An example also that comes to mind is our own industry, as Chandresh mentioned, that we have also been at the forefront of this, while moving from a completely brick and mortar or distribution-led model to move online when COVID forced us to do so, and yet being able to generate business and give the right kind of solutions to our clientele. Something what we are doing today, like a NFO launch would have happened on a more physical front. But today we are seeing that all of these things are much easily transformed online, and we are all able to sort of enable this because of the adaptation that has happened across our various industries. Even in the life insurance space, one of the leaders, like an HDFC Life, has been innovating on various new products over the last few years. But what was also important is they also innovated on their distribution channels. While they saw that online insurance is going to be the next big thing, they ensured that they had right kind of partners in the likes of Ola, Ubers for their direct clientele, or Paytms, or for that matter, even Airtel. And today they have a substantial market share in the online insurance space. And that clearly shows that one has to really adapt much earlier. And if they are able to see the disruption earlier, there is enough opportunity versus, gaining market share compared to your peers. If we move to the next slide, in terms of, so as we said, a large part of this special situations fund, which is largely related to, looking at something away from the business as usual, is going to be disruption, because that's the long-term change. That's a long-term sort of a sustainable change that we believe is going to happen across various industries. But what is also important is to look at a few of the medium-term changes that are happening across various sectors in terms of sector dynamic shifts. Like, for example, here we're talking about a cyclical sector like global economic or led oil cycles, etc. And a company like Bharat Forge, if you see at its historical charts, clearly fits into that cycle, where every 2-3 years there is a cycle up or down, where the stock moves in line with how its clients are able to sort of generate business or not. And entry and exit into these sort of companies at the right time can also generate substantial returns. The another way of looking at sector dynamic shifts is on a structural basis. And as we discussed, there are various changes that COVID has brought about in terms of people, or let's say the global innovators or global companies, looking at other alternatives from China, especially in the chemical industry. And as we are mentioning here, an example of a pharma company who has been the leader, in terms of cost. And because of that, now it is seeing many more opportunities from global clients in terms of structural change that has been brought about by COVID, where companies are looking for an alternative to China, or a China plus one strategy. If we move to the next slide, There are also some short-term or event-based opportunities that this fund will also target as and when they are available. An example here is a legacy IT company, one of the leaders in the past, and over a period of time probably was seeing some bit of stagnation, has seen a new bit of life, both in terms of how the market is looking at it because of the event of a new management change, as well as the management structure and strategy that they are talking about. Clearly, such kind of events, there are other events that can happen in various companies, such as a merger or a demerger, that can result in event-based opportunities across various sectors and various companies, which this fund will also target. So just moving to the next slide. Now, here we are looking at how the overall portfolio is going to be built, how the Axis Special Situations is going to be built. Is that in the core of this fund will be disruption theme, which will be about at least 70% of the fund across disruptors, adapters, or enablers. And about 20 to 30% of this fund will be part of the global fund, the advice that Schroders will give us, and I'll come in a minute of how that is going to work out. But the remaining portion, which is about 70 to 80% of the fund, is going to be domestic stocks. Again, in that, there will be disruption, which will be the core theme across various sectors. And then finally, we will have about 10 to 30% of the fund in the short-term event-based or the medium-term sector dynamic shifts. What is important to understand here is that there will not be many stocks or probably a few sectors which are doing reasonably well, which have a very good ROE, but unfortunately there is no disruption-led growth that is happening in those sectors. A few examples here could come to mind would be, let's say, an FMCG sector, or let's say a sector like pharma industry, especially the US generic companies or the domestic pharma companies, which are largely focused on branded generic products. We do not see a high level of disruption-led growth happening from a medium to long-term perspective in these industries, and hence they would probably be not represented in this sector, in this fund. What is also important is a few other sectors like probably the auto industry, or even sectors like cement, commodity-led segments, sectors would also not be prevalent in this, and for that matter, even some of the sectors which are linked to infrastructure, if we do not find enough profitable disruptive growth in those sectors. And hence, there will be some bit of differentiation, some bit of diversification, which is different from, let's say, a pure diversified fund that has the exposure across various themes, across various sectors. If we come to the next slide, from a global perspective, we will have about 20 to 30 stocks. These will be part of the global disruption strategy that Schroders has been running for the last 2 years, the fund that they have been running. They will be giving us a curated list out of that. Again, it will be across the disruptors, enablers, and adapters in line with the philosophy that we are using. And also in terms of execution, we will be directly investing into these stocks, and we have the capability to do that. We have been doing that in our existing funds like Growth Opportunities Funds and the ESG Fund for the last few years. If we move to the next slide. So, that's where we, would like to summarize this presentation. And a few slides after this will kind of give you a summary of what we really mean and why we would, feel that investors should invest in this fund. One is, yes, I mean, disruption is something which is an opportunity that can be captured over a period of time if we are able to enter them at the right point of time. And this fund, we believe, will be able to capture that across value chains, both in domestic as well as global markets, given that we have the right sort of advisory from Schroders, which will be extremely helpful to understand what's happening across various industries, across newer and newer disruptions stories that are happening in various parts of the world. So obviously, this is a thematic fund. It is different from a generic diversified fund, and I briefly explained on what kind of differentiation that it would be there in terms of the kind of stocks, especially in the kind of sectors which we will not have in this fund. And yes, I mean, we believe that this kind of a fund is something that will complement anybody who has a sort of exposure to various other growth strategies across our or other investments that an investor has. So from that perspective, yes, there will be some bit of higher what we call as a tracking error that will be there in this fund, let's say from an index perspective. And to that extent, we believe that the higher returns that we expect from this will be over a period of, let's say, 5 years or above, given that there is a relatively higher level of tracking error that there is there in this fund. If we move to the next slide. So, just to summarize the various funds that we have launched recently across the board, starting with the Growth Opportunities Fund, the ESG Fund, Global Equity, as well as the Access Special Situations Fund. Out here, the allocation to equities is in the range of 20 to 35%, similar to Growth Opportunities and ESG Fund. We will be investing directly. Again, that remains a commonality, but that's probably where the commonality ends. A growth opportunities fund, as we know, is largely targeting large and mid cap funds category. But out here, it is a thematic sort of a strategy, which means we'll be running it as a multi cap fund. While at this point of time, given the mix that we find in terms of our universe, in terms of the opportunities, we believe that about 70% of the fund will be in large caps. But really, it is a completely multi-cap, open-ended strategy where we can go bottom up, and if we find more and more mid and small cap companies, there could be, that difference that will be there in this fund. In terms of global exposure, again, let's say a growth opportunities fund looks at global large caps. Most global themes would be the larger ones that are there globally. But when we talk about a special situations fund kind of a story, we are looking at disruptive growth. And necessarily, there will be various ideas that are there in the world, which are also there in the large and mid cap space, which means that the mix that the advice that we will get from Schroders will be of a multi cap nature. Again, when we talk about multi cap from a global perspective, one needs to understand even a mid cap from a global perspective is about $10 billion to $100 billion. So from our perspective, they are still large cap companies. And as we mentioned, a diversified fund like a growth opportunities, one looks at an ideal investment horizon of 3 years and above, and a thematic fund like an ESG or a special situation fund, we look at a time horizon of investment of about 5 years and above, given the kind of risk return profile that we are targeting. Just moving to the next slide, again, we are summarizing in terms of how these funds could be different from what we have already launched. And to that extent, we can clearly see that there is, in the diversified strategies such as the Axis Growth Opportunities, which is targeting India plus the world, or the Global Equity Alpha, which is primarily targeting global thematic stories, global diversified stories. These are both diversified strategies. They can look at various points of various themes while investing across various exciting opportunities to invest in various sectors. While the thematic strategies such as an ESG is largely focused on sustainable high growth companies, while a special situation fund is looking at disruptive growth, which means alpha generation across innovative ideas. But both of these funds are largely thematic in nature, and hence the investor horizon is relatively longer. Just to move to the next slide, a summary of the fund facts. As we mentioned, it's a thematic scheme. The benchmark will be Nifty 500. The NFO period starts from 4th of December 2020, and it runs till 18th December 2020. So I think we have covered the presentation largely. Let me hand it over back for any further questions. Ashwin?
Yeah, thanks for that, Ashish. And hello and good evening, everyone. Just to summarize, I think Ashish covered it in great detail for everyone's benefit. The unique features of the Special Situation Fund is that it is a thematic product that allows you to capture this very, very relevant space which is there in today's markets, which is companies that are benefiting from the disruptive change that is going on and that can grow on a disproportionate basis. And it does so by allocating across the market cap spectrum, both in India and abroad. And essentially, therefore, it creates it provides a great allocation for equity investors who are traditionally, you're looking at it from regular diversified or large cap, mid cap kind of buckets. It provides a great, a complementary allocation for these investors who are trying to capture these type of themes. With that, let me, open it up for questions. A lot of you have been writing in with your questions, and I'll try and cover as many as we can. Maybe the first one is is the most popular question so far on this, and I'll go to Jinesh with that first. Uh, Jinesh, lots and lots of questions about the current market levels and the fact that market is at an all-time high, and what are your thoughts on that? Also, people are linking it to say that why are we doing an NFO at these levels, etc. So maybe if you can just talk a little bit about overall how you are seeing the markets currently.
Yeah, thanks, Ashwin. See, clearly, if you really see where market is, in fact, it is just the reversal to the mean in some form of a longer V-shaped kind of a recovery, where you would have seen in Jan, Feb, we were markets was doing very well. Economy was about to turn for positive, and there was expectation that economy will go back to, let's say, 6-7% GDP growth rate. Unfortunately, we had COVID, which came in, and hence in the initial pandemic period, when the lockdown started, we had a lot of nervousness that what will happen to the economy after the lockdown after the economy opens up. To our surprise, to corporate surprise, and to everyone's surprise, the resilience of the India and the Indian economy and of Indians is phenomenal. And that is where has been the markets have seen that coming, and you saw markets starting to move up by May, June, August, September, and then it now hitting the new highs. Clearly, what has happened is the big theme which we used to play, we used to talk about, let's say, the unorganized to organized trade. We thought that will happen during demonetization. We thought that will happen during GST implementation. That theme has really been playing now. And we talk to any listed company who is a leader in their space. Clearly, they are of the view that we are at more than pre-COVID levels, but maybe the sector is not there, which means that the listed companies, the efficient companies, the tax-paying companies are able to grab market share all across in all the sectors. So be it building material company to paint company to any other company, there is a significant shift from organized unorganized to organized play, and that is where you would see Q2 numbers were surprise in terms of the outcomes, in terms of the revenue growth, in terms of margin, ability of the company to push to cut down the cost structures, and at the same time report decent profitable growth, which was not the expectation, and hence market has already taken that cue. And as market is a collective wisdom of many intellectuals, the market took that cue, and now it is back to pre-COVID levels. So what I'm trying to say is the Nifty earnings or maybe BSE 200 earnings is already back to pre-COVID levels. Having said that, I'm not saying everything is hunky-dory and things are going to be one way up only. Fortunately, we have loads of money again sloshing around the world. After this pandemic, also you had lot of quantitative easing which has happened in US, Europe, even in China. And post US election, there is a thought that a lot of money can come to emerging markets over next 12 to 18 months time, given relatively cheap valuation of the emerging market as compared to developed world, and at the same time ability to open up the economy and run the economy better than let's say the Europe or the US economies. So it's a clear, I would say, a recovery of the economy. Having said that, there is always a caveat: we don't enter into second wave or a third wave. If that happens, then and there are lockdowns, then again we will be under pressure. But otherwise, we are not seeing a scenario that there could be a big collapse in the market, except for any black swan event which comes, or if there is a second wave or a third wave which will come. And if history goes by, during global financial crisis, we had $56 billion outflow during that global financial crisis in 2008-9, and then you had 70 and 80 billion dollars each inflow in the emerging market. If that goes true, and that is what the expectation is running around even now, because of the economies have opened up doing well, uh, we might be in for a big tsunami of flows. I don't know whether it will be in next 1 month, 2 month, 3 month, but definitely it looks like as dollar weakens, there will be huge flows which can come to emerging markets, and India will also get fair share of its flows. In fact, in last month itself, we have received $13 billion of flow, which is a massive number, and that is why markets are where they are.
Thanks, Dinesh. So I think the important thing is that markets have come back quite well. The economy is responding far better than people expected from a COVID perspective. And from our fund launch perspective, what we want to highlight is that clearly it's a theme for the future. It's the theme for the long term. So it's not just about this month or next month in the market. We want people to be able to access this theme from a longer term perspective. So basically, from a long term, any time is the right time, is what they say. So that's why we are doing it now. Moving to Ashish, I think quite a few questions on how to position this fund. Some of them are asking, do you call this a sectoral fund? Would you call it like, how do you position it for the investors?
Right. So obviously, as we said, this is clearly, working on, and the core theme of this fund is going to be disruption. While we have said that, event-based and sector dynamics will be a smaller portion of the fund, the much bigger portion, about 70-80% of the fund is going to be on the disruption theme. Part of it, which is going to come from the global space that Schroders advises, and also looking at in various Indian companies. Now, as we discussed across the presentation, that there will be sectors and there will be companies across various sectors that kind of make the cut as disruption, as in the disruption theme, in terms of this being disruptors or being enablers of these disruptions, or adapting to them. So to that extent, there will be a fair representation across various sectors, be it financials or maybe even IT, or let's say going down to other sectors like telecom, or for that matter even capital goods segment. And there will be a few other segments that having sectors having relatively lower ranking. What we also mentioned briefly is that some sectors which are quite business as usual, where probably even the companies are doing really well in terms of higher ROE, but because we are not seeing disruptive growth, they would probably be missing from this. To that extent, there will be some bit of higher differentiation versus, let's say, our existing funds, as well as the overall index.
Thanks for that, Ashish. So important thing for everyone, to summarize Ashish's point, don't look at this as a sector fund. Disruption is a theme that works across different sectors. A number of mainstream sectors have been touched by disruption. Ashish gave a number of good examples. There are a number of case studies we have put in the presentation, which hopefully we will, many of you would have already received. If not, please reach out to your Axis Mutual Fund sales touch point, and we'll be happy to share with you. There are lots of case studies of how disruption is changing lives all around us as we speak. Lots of questions about why global investing is so important, and maybe Jinesh, you can also pitch in here. People are asking a question saying, we are getting many funds in Axis Mutual Fund where we have started having global allocations now, 3 or 4 funds. So why for investors, having this global, or even for Axis Mutual Fund, it is such an important thing to start looking at, beyond India when we have to start looking at investments.
Thanks, Ashwin. So we have Axis Growth Opportunities, Axis ESG Fund, and Axis Fund of Funds, and now we have Axis Special Situation. I think one thing what we have learned over the last 10 years is the global disruption or global innovation, or the new companies which are coming and becoming the star of the world are not from India, right? Some of them are not from India. But obviously there is now a possibility to play those given the relaxation of the I would say regulators, in terms of allowing Indian investors to play into those names. So means if we are using those products on a day-to-day basis, for example, Apple, why you should not buy Apple as your investment thesis, right? At the end of the day. So we really feel that there are many business models which are not available in India to play for a retail investor or even for an HNI on a consistent basis. You can always invest through unlisted HNI. HNIs can invest through unlisted, but you run a big risk of whether that companies will get listed or not get listed, or what is the time frame of that. But here are some of the companies who have constantly delivered on innovation, delivered on free cash flows, and delivery, and continue to deliver on global platform. And we are very convinced, and obviously thanks to Schroders also, the way they have sort of helped us learning this curve is clearly there is a lot of opportunities all across the world. There are very many beautiful companies, let's say in Israel, in Canada, in China, or even in US, where for us it will be impossible to play around for next decade. But if we are able to invest through that vehicle, then why not invest? So I feel, and this is our house view, that if the opportunity is there, then why not invest?
Thanks, Jinesh. And that's the important observation that, there are fantastic companies available everywhere. There are very large global markets out there, thousands and thousands of listed stocks. So having 3-4 funds makes a lot of sense, especially since the 3-4 funds, as Ashish has explained earlier, are reasonably differentiated. Growth opportunities plays more on the large cap side, ESG is more on the sustainable theme, and now we have disruption coming into this fund, which is the Access Special Situation Fund. Ashish, back to you. One question, again, quite a few are asking, is that how do you see this differently from the other funds that you manage, or for that matter in Axis Mutual Fund we manage? Because one query people have is that if there are some good stories, then maybe they'll be there in our other portfolios also. So, so related question, how differentiated will the portfolios be, or how do we play it differently from our other portfolios?
Right. Thank you for the question. So, yes, Ashwin, we obviously will have quite a bit of differentiation, as we mentioned, because we are, sort of not just looking at high quality companies. That's obviously the first filter that is there to invest in any of our funds. But more importantly, what we are looking at is a growth which is led by disruption. This kind of, lens which is there in front of us, where we are trying to find businesses which have innovated either to create a disruption or enable it, or sort of adapt to it, has to be material from a medium to long term perspective. What we mean by that is, the kind of disruption led growth that we are going to see here should be probably a substantial part of their not just their top line or sales, but eventually making a higher amount of sustainable profits as well as cash flows over medium to long term. By what we mean by medium to long term is probably 5 to 10 years down the line, we should start seeing the disruptions that, or the innovations that they are doing today, should lead to a sort of a higher level of growth, and a bigger portion of that coming from that. So the value that this kind of disruptive growth generates is not available across most of the stocks that we have, even in our universe of high quality stocks, because most of the businesses that we see in the listed space are probably looking at relatively business as usual, maybe doing some bit of incremental changes in their business models, but not really going through the kind of disruptive change that is going to be qualifying them for being part of our disruption team or the portfolio that we are building. And to that extent, the portfolio that we have tried to sort of build for this kind of portfolio will probably be highly differentiated. The kind of matching that we have with our current frontline funds, as well as the other funds that I manage, will probably be less than 50%. is what we believe. And that is also the case if we go on the global side and look at, let's say the advice or the strategy that Schroders is running on their current global fund versus the fund that is advising our growth opportunities fund. Even there, we believe the sort of mismatch would be at least 50% or higher. So that's the kind of differentiation we are trying to bring here with the theme that we are trying to run here and the kind of strategy that we are trying to build.
No, thanks. I think clearly the theme has, as we explained already earlier, it's a reasonably broad theme, allows us to create a robust portfolio, but at the same time, a sharply defined theme in the sense that only companies that qualify will make the cut. So big difference between any normal diversified strategy that we run, where basically all good quality ideas make it into the portfolio. So the portfolio is reasonably diversified. Whereas when you come into a thematic product, the biggest differentiator or the biggest point about any thematic product is, as an investor, as a distributor, as an advisor, it allows you to sharply position into one segment of the market. In this case, a disruption segment. So if you have a view that this segment will really do disproportionately better, it allows you to capture that in your portfolio in a targeted manner. Also, it allows us as fund managers to clearly bring out our convictions. So it's our belief, our conviction that disruption is something that is going to be a game changer. It's going to be a massive thing in the market going forward. And in that sense, doing this fund is also our way of saying, just like what we did with the ESG and the sustainability theme that we did about 8-10 months ago, is to say that this is going to be a massive trend for the markets going forward. And as advisors, distributors, as investors, we should be on top of this trend going forward. Back to you, Ashish. One of the concerns people have raised is that being a more thematic product, or the kind of approach that we have here, will this mean that from a portfolio perspective, so 2-3 interrelated points, does it mean that it will be more volatile? Does it mean that the ideas will be churned more often? So how do you see that part going through in the day-to-day portfolio?
Right. So I guess I'll take the second part first in terms of the portfolio being volatile as well as the churn. I guess what we are looking for when we say disruption is a long-term sort of strategies or growth opportunities that various sectors will allow us. And that's not something that will probably change on a day-to-day basis. When we look at a particular company, look at their strategy and what sort of changes they are looking over a period of time. But also what is important then is to understand if there is any particular reason that, because let's say, because there is some regulatory change, something that happened in probably like Alipay recently, or let's say basically and financial, or for that matter, what's happening globally in terms of some of the data related issues that, in terms of security, etc. And monopolistic behavior that various governments are talking about. So if there is a disruption that is happening based on certain level of assumptions, and there is a regulatory change because of which the disruption might not be as big, that could be a reason for us to sort of look at the stock or the company differently. That probably can result in some changes. And similarly, various other things can happen. While we talked about the likes of Grofers and Big Basket as disruptors, but we know that there are other players, the likes of GeoMart, etc., or other players that can probably disrupt even these disruptors. So we will have to sort of keep a close watch across various companies here. And as we know, it's a highly evolving sort of a industry. And obviously many things that can go even better than expected, but as well as not as good as what we expect, and we will have to be on top of things. To that extent, there will be, yes, some level of churn, but that is true of any other fund or any other scheme that we run. That we know, obviously, we look at businesses of what strategies the managements are running, and we'll obviously take a call on an ongoing basis. On the other point on volatility, I guess what I said earlier is that there are a few sectors from versus let's say a pure diversified fund which we run in the large cap space, etc. That we run, we clearly say that our volatility would be lesser than the index. But what we are saying here is because some of the sectors would unfortunately not make the cut of being disruptive. To that extent, the differences from us versus let's say the index would be higher, and that is what results into higher tracking error over a period of time, which generally means that there will be some bit of higher risk, and hence we require a slightly longer time horizon in terms of investments in such kind of thematic funds versus a pure diversified fund, and hence the 5 year plus time horizon that we have put in.
So yeah, so it as is normally seen, ideas with higher alpha potential are also ideas which have or let's say higher growth potential are also ideas which require you to take a higher conviction views, which are a little different from what the market or the benchmarks are doing. And this theme is a great way for us to create a very differentiated portfolio to do so. There is one question which a few have asked about, and I'll just try and quickly take that myself. Is there have been a few special situation funds that have happened in the market, and how is this fund different from those? There is a related question saying, are there comparable funds like this in the market? And the answer is that there have been a few funds that have been called special situations, but the strategy that they followed were very different from what we are proposing. So in that sense, this is probably a unique fund in the market right now. There are not too many, if at all. There is no, in fact, none at all, which are there in the market. In the market, you normally get either sectoral funds or diversified funds, or funds like value or contra. But funds that are playing a theme, which is a long-term theme, in the market is something that is reasonably rare. In fact, one of the criticism of the special situations, as done by some of the competition, is that it is focusing too much on events. And events have two problems. One is they can be shorter term in nature, and second is the opportunities can come and go. Whereas when we talk about long-term disruption as the core part of this theme, essentially this becomes much more about the long-term opportunity that is available in the market, and which, as Ashish has correctly explained over the presentation that we're talking about. One sort of overall question also, Ashish, is that you spoke about the horizon. People are also concerned about the market, while of course Jinesh did answer that question. So how do you suggest people should look at this as a regular investments, as longer term allocation that they can make? So any thoughts on that in terms of how people should just take, how can they, participate in such a way that they don't get hurt in case there is market volatility?
Right, absolutely. So one thing is very clear, that when we look at equities, it's not something that we put in the market or try to time the market, that this is the best time to sort of invest in stocks, or over the overall market levels. We will obviously keep finding newer and newer opportunities across various sectors, and we will keep finding newer and newer stocks to invest in, as and when themes are evolving. And especially as we have spoken about, this particular fund and this particular disruption as a theme, what we are finding is, India is just, sort of on the cusp of many of these sectors, which are about to sort of, mature and grow. So while we are seeing many opportunities in the listed space, we are also, as we briefly mentioned in the presentation, looking at least 20 to 30 new age, new economy stocks or new economy segments that would probably hit the market in the next 2 to 3 years. And so there is going to be continuous sort of opportunities from Indian equity market perspective to look at some of these stocks, and newer and sort of newer stories that come in. And as we said, it's only 70%. There is also 20 to 30% of the fund which is from the global front, where we are going to see more and more innovations across various sectors. And as these gather pace, there will be opportunities that are there across the world also. So to that extent, we believe that from an investment perspective, because these opportunities are ongoing and will keep coming into the market, there will be opportunities from this fund perspective to sort of keep looking at entering these spaces. And it's not that we invest all the money today, and then 6 months down the line, we are done with our ideas and there is nothing more happening. So to that extent, a regular investment into any of these kind of funds, where we keep getting, entry into newer stocks, and from an investor perspective, they keep getting, higher sort of corpus here, will make sense. What we also mentioned earlier was important is that this fund sort of has to fit into the existing portfolio of diversified funds that an investor holds. So, for example, if somebody holds a multi-cap fund, as well as, let's say, a mid or a small cap fund, in addition to that, they could probably look at this fund as an additional exposure to a very new theme, newer set of economy that is being generated, and a newer set of stocks, both India and global.
Thanks. So to summarize, Ashish's points, uh, 2, 3 things that we are doing to make sure that investors have a smooth journey. One is, of course, that we look at long-term themes. I think that's the most important thing when you look at Axis Mutual Fund, and good quality stocks over long term. That is something that will remain core and central to all our products, and indeed into this one as well. From an investor's perspective, do make sure that you make regular investments, while of course, because this is a new theme which is not really available in the market so far, a certain lump sum allocation in the NFO could be considered, but definitely it has to be combined with some regular investments through either SIPs or whatever is a convenient mode. The second point, as Ashish correctly mentioned, was that we should have a reasonable horizon when you allocate into long-term strategies like these. So typically having a reasonably long horizon, like let's say 5 years or so, is where the wealth generation potential really comes into play for compounding stories like this. Let's turn to some slightly different direction, maybe to Jinesh. Back to Jinesh. Jinesh, one question one or two advisors are asking is, we've had a great ride with Axis Mutual Fund in terms of performance. Our style of quality and our consistency in the portfolio has really served us well across our portfolios. So how do you see that playing out over the next 2-3 years? Do you think that this style will remain relevant? Is there something that we are doing which will be different, or will it be more of the same as far as Axis Mutual Fund is concerned?
Thanks, Ashwin. Style, as we all know, unless and until we have a value fund, we will have a growth style. We have a growth backed by innovation, backed by good, well-governed companies, promoters, and ultimately everything is ROE and cash flow driven. Friends, what I feel is growth is now moral responsibility of each and every company and each and every country to ensure that there is prosperity all across. And at least I have seen in my career, or at least as a house, we have seen that without growth, at some point, company crumbles as they start losing good talent, as they start losing investment opportunities into innovative themes, and as the cash flows and the ROEs dwindle, those companies eventually die down. So my long-term thesis is growth is a moral responsibility for a company, for prosperity of its own enterprise, of its employees, and growth is moral responsibility of the country to ensure there is a GDP growth and there is a prosperity in the country. So this theme will continue for, I feel the growth is life in that sense. Maybe the styles in the market, you might see 6 months of other styles doing well, but you have seen us now for 11 years. I would sincerely urge you to look at Axis with a very, very long-term view, let's say 3 to 5 year kind of a view, because when we invest in companies also, we invest with 3 to 5 year view. We don't follow any momentum trades. We don't follow those near-term trades where and we don't try to confuse ourselves between growth, value, or dividend players. So I think we really feel that growth is life, And at the end of the day, as you are seeing, wherever there is growth, there is good talent available, and that talent brings that company to next level altogether. So I would say will not change our style unless we have a value fund. Even in that, we might come out with something unique in that.
Thanks, Dinesh.
Thank you.
Back to Ashish, you did mention that there will be a lot of upcoming new companies that are going to be hitting the market, especially some of these companies who are, aggressively disrupting some of these existing markets around us. One question people are asking is that, as a fund, will we be looking at investing in these companies before the listing, as in an unlisted space, or during the IPO and subsequent?
So we will be investing into these companies when they come for an IPO, if possible, as an anchor investor, but not before that.
Great. I think
Ashwin, just to add, if at all there is a change in regulation, and
yes.
if the regulator allows us, then definitely we would like to invest early also.
Correct. So just friends, just to summarize, from Jinesh and Ashish's perspective, that the plan is to come in pretty much around the IPO time, because the current environment, we do not have the ability to come in before that as a fund house. But if there are good opportunities going forward, or if the environment changes going forward, then we may be allowed to change that going forward. But definitely, one thing, as Ashish highlighted, is that a lot of these good companies are talking about getting listed in the very near future. And that is why we are very excited. And somebody did ask a question about timing. And then two factors which clearly, from a timing perspective, highlight the growing importance of this trend. One is the post-COVID disruption that we have seen around India, everywhere. And the second one is the likelihood of so many of these companies coming to the listed space over the near future. Ashish, one question is in terms of the link between the global part of the portfolio and the domestic part of the portfolio. How do you see that interplay happening, and how will that influence how you are constructing or going about putting together the portfolio?
Right. So obviously there will be a lot of discussion that we will be doing with Schroders as we look at their advisory, and if at all we feel that there is some bit of higher overlap, we could probably ask them to sort of look at a sort our own portfolio and advise us on how we can make it complementary. It's not necessary that we will not have any overlaps, because obviously a lot of themes, for example, let's say getting online or digital, is something that is happening in India as well as globally. But if you look at our own economy in general, we have quite a bit of tilt towards specific sectors. Maybe as an economy we are more service oriented. But from a global perspective, the innovations that are happening are across various sectors. They're happening across various countries. They're happening across, various manufacturing sectors. For that matter, even on the technology side or even on the services side, the kind of innovations that are happening there are quite different from what we are seeing here. And maybe not just B2C oriented, but even B2B, etc. So to that extent, there is a wide spectrum that is there when we look at the global ecosphere in terms of in terms of disruption side. Although some of them might be already on their way in terms of getting to a let's say higher level of maturity, but many of them are newer, and many of newer regions are sort of getting disrupted more and more. So to that extent, the opportunities are only increasing globally as well as in India, and it is happening across various facets and various sectors.
Thanks. And some related questions on the international investing. I think some people have asked about the taxation. So just reiterating that this fund will have around 65 to 70% of its portfolio at least in domestic equity stocks. So in that sense, it will get treatment like an equity fund. in India. So the global equity stock allocation will be around 30% or so. Moving on, Ashish, one criticism of looking at global allocation is that people worry that is it that we are investing abroad because opportunities in India are more limited. How do you respond to such concerns?
Right. Clearly, as we said, over the last 5 to 10 years, we have seen disruptions and disruptive changes led by various technological advancements being happening across most developed countries, starting from US, China, Europe, etc. And these business models, over a period of time, matured to the extent that they have now listed in the market and are available directly to invest. So to that extent, there is a lot of learning that we can get from these companies. There is a lot of growth that is possible here in terms of the R&D led innovation that we are seeing in these companies. And these are, as we keep saying, there are various technologies that are being happening globally. While in India also some of them are sort of getting replicated, or to that extent are seeing the next level of growth with COVID. The kind of opportunities that are there globally are much more, and also it kind of gives us, if you look at as an asset class itself, while we look at domestic equities and domestic stocks as a very high growth sort of a place, there is also an asset class like a global equities where we also sort of have a lesser relative correlation. And because of, as we know, there is a benefit in having two different asset classes in the portfolio. That itself kind of gives us a benefit of high returns with relatively lower risk.
Thanks. One question, again, many are asking about is about the deployment strategy. Is it that we already have a set of stocks in mind? Are we waiting for some opportunities to crystallize over the next few months? So how will you, since this will be a reasonably large NFO from our perspective, how do you see the deployment panning out?
So from a deployment perspective, we generally look at a new fund to invest from a, let's say, 2 to 3 month perspective. Obviously, we have identified what are the potential ideas in terms of disruption-oriented theme, as well as some bit of event-based and sector-based stocks. Obviously, the decision of what sort of weightages we give to these stocks in the fund finally will depend on the eventual valuations that we sort of look at, or the eventual price that we get them, and obviously if any circumstances change. But yes, I mean the overall time horizon we are looking at is probably up to 3 months.
So essentially, there is friends, that we don't really intend to do any kind of market timing with cash. That's always our intention. Typically, when there are large launches, it is prudent to build the portfolio to take a reasonable amount of time, and that's the intention very much that we will do here. An associated question, Ashish, is what will be the typical cash levels that people can expect? How do you see from a deployment perspective your approach on that?
So yes, I mean so from a cash perspective, as we mentioned, we will look at deploying from a 3 month perspective. That is
ongoing. No,
yeah.
What I meant was on an ongoing basis.
So ongoing, obviously, we would like to remain, generally unless there is, some specific event or a reason that we are, don't want to stay invested. We would generally be invested more than 90%, or maybe even 95, as the situation sort of allows us. So obviously, the idea is not to take huge cash calls. We believe that there are enough ideas from a disruptive growth and generally from a growth perspective that are available in India and globally. And to that extent, we will not keep a lot of money in cash. What we probably would like to do, if let's say if we feel that there are better ideas globally, is have maybe 30% in global instead of, let's say, 20 or 25%, or vice versa. If we feel in India there are better opportunities coming up because of all these unlisted guys getting listed, maybe have some bit of higher allocation here, but rather than putting money into cash.
Thanks. Staying on the portfolio, Ashish, some questions on how do you see the concentration in terms of the number of stocks, since that this will be a reasonably tight theme. What do you expect in terms of the number of stocks that you will own in the portfolio?
Right. So the clear, easy answer from a global perspective, we will have about 20 to 30 stocks, which Schroders will advise us on from their strategy. On the domestic side, as we said, disruption is the core, and hence, let's say if we are building about 30-35 stock portfolio, out of which about 18 to 20 stocks would be from the disruption theme. And we would have about 4 to 5 stocks either from event-based and or from sector dynamic shift based stocks. So those will be opportunistic. We don't know today if there is an event going to happen where we are presented with a few stocks that that we can play in that opportunistic play. But that's the general range we are looking at, about 30 stocks or maybe up to 35.
No, absolutely. So I think for all of you, you've seen how we have been managing funds all these years for Axis Mutual Fund. I think we like running compact portfolios. We like having higher conviction into companies that are reasonably strong performers, which we really like and we can back for a longer period of time. And a long-term theme like disruption allows us to play to these strengths, get in early on good ideas and stay invested for the long term is the mantra. And that's pretty much what we want to do. Having said that, risk has to be we have to be very sensitive to, so we cannot keep limiting the number of stocks to a abnormal level. Somebody asked a question, can you have a 10 stock portfolio? Answer is clearly that's not very viable, because also you would need to have allocation across a number of sectors, ideas, etc., to make the portfolio more robust. So it will be a compact portfolio. It will be a high conviction portfolio, similar to how Axis's other funds run, but while keeping risk as a important part of that. One question, Ashish, is because there is global investing involved, is related to currency. Investing in global stocks, does that involve taking some kind of a view on currency or hedging for currency at all?
No, we don't intend to take any particular view on currencies. As and when we get the funds to deploy, we would be putting into the ideas that Schroders advises us on. So the currency part of it will be largely floating.
Great. Maybe I'll say for the final word, unless there are other questions, please come back to us. But let me go back to Jinesh. And Jinesh, overall, one of the questions we get asked a lot is on valuation, especially for the better quality stocks. They tend to trade at a premium, and we have seen that not just in India but globally. I think that has been the case. So people are saying that in terms of valuations, what is our view in terms of especially the good quality stocks, what we have seen, and how do you see that playing out?
Correct. So thanks, Ashwin. Valuation has to be seen in the context of the cost of capital also, right? So when you do a discounted cash flow method, and if your cost of capital has just collapsed, so obviously the value of equity goes up. And that is what has happened over the last 10 years. As the cost of capital is collapsing, the money around is sloshing around the world. There are very few well-governed companies, and the premium for governance, the premium for good quality growth, the premium for cash flow, the premium for dividend is all taken into consideration while anyone is valuing the company, right? We are not the only guys who are valuing a particular stock at X multiple, right? It is a function of the market participants. It's a wisdom of all the market participants. So obviously a company gets valued at, depending on the numbers, cash flows, and all those things at an X valuation. Then there is premium to growth, premium to governance, premium to scalability of the business model. So all this taken into account, you arrive at certain number. And as the cost of capital has collapsed, the valuations have gone up. I don't know when this money will reverse and the cost of capital will rise, but till that time, the cost of capital remains at what level it is. You will find a lot of flows chasing few stories, and hence the valuation might remain expensive. I would not call expensive because it depends on how the financial metrics play.
Uh,
Am I audible?
yeah, Janesh.
Sorry, am I
Yeah,
audible?
you're audible now.
Yeah. So I was just saying that it is a function of the overall financial markets and the way cost of capital has been moving. Uh, so uh, so I'm not the only guy who is trying to value that story at that level. I think it is more about longevity, premium to governance, premium to growth.
Uh, Thank you so much, Jinesh. Thank you so much, Ashish. I think we've covered a bunch of questions. Friends, thanks a lot for joining us today. Just a quick shout, Manesh, are you there? Uh, uh,
Yeah, Ashwin, I'm there. Yeah.
yeah, over to you, Manesh.
Yeah. Thanks, Ashwin. Thanks, Ashish. Thanks, Dinesh, for walking us through the new product launch. I'm sure all of you all would have heard about the merit of launching the Access Special Situation Fund. Just to reiterate, it's not another special situation fund that you essentially would have seen, from the mutual fund space. This is a differentiated product, and the idea of launching this fund is to basically capture what we truly believe is companies which will essentially create significant amount of wealth and alpha for clients on their portfolio. I'm sure you would have appreciated at Axis. Our endeavor always is to launch a product which is essentially differentiated and add value to our clients' portfolio. So thank you all for joining in for this call and giving us an opportunity once again. And we look forward to your help in terms of reaching out to your investors in terms of taking our product out. So thank you once again, and please feel free to reach out to any one of our relationship managers should you require any further information. Just one final parting remark is that the NFO starts on 4th of December and will be closing on 18th December, and then reopen for ongoing sales from towards the end of the month. So thank you once again for joining us for the new product launch. Thank you so much, and goodbye and stay safe.
Thank you. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.